In 1968, the US dollar faced annihilation. The foundation of the post-war Bretton Woods system was cracking. Foreign governments, led by France under Charles de Gaulle, were trading their swelling dollar reserves for physical gold at a furious pace, threatening to empty Fort Knox and shatter confidence in America's currency. The U.S. response wasn't mere diplomacy or rate hikes. It was a financial declaration of war. For 7 years, a secret cartel known as the London Gold Pool had been the first line of defense. Comprising the U.S. Federal Reserve and 7 European central banks, its mission was explicit: manipulate the free market gold price in London to maintain the official 35 per ounce peg. According to Bank for International Settlements archives and academic reconstruction, this pool sold a staggering 3,000 tons of gold, worth over $3.5 billion at the time, between 1961 and 1968, to cap the price. This was state-sponsored price suppression on a monumental scale. They lost. A speculative tidal wave, fueled by dollar distrust and the costs of the Vietnam War, broke the pool in March 1968, forcing a two-tier market and leading directly to Nixon's closure of the gold window in 1971. We're taught that free, transparent markets set prices. But when the existence of the global reserve currency is at stake, history shows the state becomes the ultimate clandestine market participant. The 1960s proved that. The playbook written then, the deliberate, coordinated destruction of gold's monetary value to preserve dollar hegemony, never died. It simply went into the shadows, a last resort option in the Treasury's crisis handbook. Today, with the dollar under a new, more profound multi-front attack from BRICS de-dollarization and central bank accumulation, the logic of the gold pool isn't ancient history, it's a chilling preview. What would a modern 21st century version of this financial weapon look like? And could the US and its allies, by orchestrating the destruction of $12 trillion in perceived precious metals wealth, deliver a killing blow to the de-dollarization movement? To answer that, we must first understand the brutal mechanics of the original pool, and the precise reason for its catastrophic failure. The blueprint was born from a fatal flaw in the Bretton Woods system. The U.S. had pledged to redeem dollars for gold at $35 per ounce for foreign governments, creating the illusion of stability. But as chronic U.S. balance of payments deficits grew post-2022, financing the Marshall Plan and global military commitments, the fundamental math became suspect. More dollars circulated globally than there was gold in Fort Knox to back them. Confidence eroded, and physical gold began its inexorable journey from the vaults of the Federal Reserve Bank of New York to the Banque de France and the Bank of England. The American solution was not fiscal discipline, but financial engineering. In late 1961, as documented in Federal Open Market Committee memos, the U.S. Federal Reserve orchestrated a secret cartel with 7 European central banks, the London Gold Pool. The Bank of England acted as its agent. The mandate was clear and audacious. Whenever the free market price of gold in London threatened to rise above $35.20, a mere 20-cent buffer, the pool would unleash physical gold from its collective reserves to crush the price. Their goal was to make betting against the dollar gold peg a guaranteed punishing loss for speculators. The mechanics, detailed in European central bank historical papers, reveal its sophistication. This was a sterilized intervention. They sold physical gold onto the London market, but used the dollar proceeds to buy European currencies. These currencies were then funneled through swaps to neutralize the transaction's impact on the money supply. It was pure, surgical price suppression, deliberately divorced from domestic monetary policy. For 7 years, it functioned as a clandestine market thermostat, selling over 3,000 tons to enforce a political price. The fatal flaw was fundamental economics. The pool was defending a fixed price in a world of exponentially increasing dollar supply. It was the ultimate price control. By 1968, speculative pressure, fueled by Great Society spending and Vietnam War deficits, became a tsunami. The pool lost $350 million in gold in a single week. The European members, led by President Charles de Gaulle's France, which had been systematically converting dollars into gold, refused to bleed more of their national treasure for what they saw as American fiscal profligacy. The cartel shattered on March 15, 1968, Gold Rush Friday. The lesson was stark. You cannot permanently defend a fixed price against fundamental imbalances. The 1968 collapse proved the U.S. lacked both the ammunition and the Allied resolve, but the corollary lesson was that you can win a protracted battle of attrition if you possess superior firepower and unity. The original pool fought the last war, defending a doomed peg. A modern intervention would not play defense. It would launch a preemptive, shock-and-awe campaign against the very concept of gold as a viable dollar alternative. The modern campaign against the dollar champions gold and silver as pristine physical alternatives to fiat paper. This narrative contains a profound and exploitable irony. The precious metals market's greatest vulnerability is not its physical scarcity, but its extreme, hyper-financialized opposite, a staggering mountain of paper claims. The physical investable stock, all privately held bars, coins, and central bank reserves, is substantial but finite. All the gold ever mined above ground is worth approximately $14 trillion, with only about $6 or $7 trillion considered liquid investment stock. Silver's total value is far less. This is the tangible, real market. Towering over it is the $12 trillion paper mountain. According to Bank for International Settlements data on over-the-counter derivatives and CME group volume reports, the market in futures, options, unallocated bank accounts, ETFs, and swaps represents derivative claims on over $12 trillion worth of metal. The COMEX gold futures market alone turns over the equivalent of the entire global physical investment stock multiple times per trading day. It is a colossal, highly leveraged, confidence-based edifice built upon a physical foundation. This leverage is its Achilles heel. In a rising market, it magnifies gains, but in reverse, it creates a nuclear multiplier for collapse. A sustained 10% price drop doesn't just erase $600–700 billion in physical value. It triggers catastrophic margin calls on that $12 trillion in notional derivatives, forcing leveraged longs, speculative hedge funds, momentum traders into a fire sale. Their forced selling drives the price lower, triggering more margin calls in a self-reinforcing financial death spiral. The system's strength, its immense liquidity, is its ultimate vulnerability. The ammunition for such an attack sits in official vaults. The US holds 8,133 tons of gold, worth $650 billion. The Eurozone holds 10,172 tons. The IMF holds 2,814 tons. A coordinated announced program to sell just 10–15% of this official sector hoard would be a physical flood into a paper-thin market. The modern advantage over 1968 is precision. The attack could be 95% paper, a massive, coordinated short assault in futures markets by government-backed entities, with physical sales held as the credible threat to break the will of leveraged speculators. The goal isn't to deliver metal, it's to bankrupt the bull thesis. The trigger for financial total war would not be a clandestine raid or a slow erosion of confidence. It would be an overt, institutional challenge to the dollar AS most sacred privilege, its role as the unit of account for global commodities. Imagine a near-future summit of an expanded BRICS Plus coalition, now including Saudi Arabia, announcing a new trade mechanism. The declaration is stark. A core basket of commodities, crude oil, liquefied natural gas, critical minerals, will now operate on a dual pricing system. Contracts can be settled in US dollars, as always, or in a new digital trade unit administered by the coalition's New Development Bank. This unit is not a currency. It is a digital claim, convertible on demand by member central banks into physical gold at a fixed ratio. Russia, Iran, and Venezuela immediately announced they will price exclusively in the new unit. Others offer a discount for its use. This petro-gold system does not replace the dollar overnight. Its initial trade volume might be just 10 or 15% of global energy flows. But the threat is existential. It creates a functioning gold-anchored alternative for a significant wedge of strategic trade. It provides a working blueprint for bypassing dollar-based sanctions and banking channels. Most dangerously, it begins to establish credible non-dollar price discovery for the world's most critical real assets. The symbolic and psychological blow is immeasurable. It declares gold, not the U.S. Treasury bond, the ultimate collateral. The traditional U.S. response toolkit fails. Sanctions against a broad coalition of major commodity producers are self-defeating and inflationary. Military action is inconceivable. Raising interest rates high enough to crush demand for the alternative system would implode the debt-saturated U.S. economy. Diplomacy has been preempted. The foundational pillars of dollar dominance are under direct assault. At this crisis point, the logic of financial war becomes inescapable. If your strategic rival is building a new monetary system anchored by gold, you do not attack each brick of the nascent structure. You destroy the anchor itself. The objective is to make gold so volatile, so treacherous, and so discredited as a store of value that no rational treasury minister or CEO would ever trust it to back a global trade system. You must demonstrate, with overwhelming force, that the United States still controls the global price of its oldest and most dangerous competitor. Thus, the shock and awe announcement is made. The U.S. Treasury Secretary, flanked by the Federal Reserve Chair and the President of the European Central Bank, unveils a joint sovereign bullion liquidity facility. Its stated purpose, per the press release, is benign: to provide liquidity and ensure orderly markets during a period of excessive, destabilizing speculation. Its real purpose is a declaration of total war. They commit to selling or lending 2,000 tons of gold from their combined reserves over the next quarter. This is the modern equivalent of Nixon closing the gold window, a unilateral rewriting of the rules to preserve primacy. But where Nixon surrendered to gold's constraint, this move seeks its conquest. The announcement is the starting gun. The battle is then fought across 3 electronic fronts simultaneously. The opening salvo is not fired in trading pits, but in servers. Phase 1 is an electronic blitzkrieg designed to shatter the $12 trillion paper mountain at its core, the derivatives complex. The battle is waged across 3 synchronized fronts. Front number 1, the COMEX avalanche. Government-backed entities, acting through primary dealer proxies or directly via the Treasury's Exchange Stabilization Fund, execute a sell program of unprecedented scale. They are not hedging a position, they are attacking a market structure. Massive, unrelenting sell orders hit the most liquid gold and silver futures contracts. They sell into every technical rally, overwhelming algorithmic bids, and systematically eroding every support level identified by quant funds. The price chart ceases to reflect supply and demand. It becomes a stair-step display of sovereign financial power, dropping 5%, 10%, then 15%. Front number 2, the ETF arbitrage breakdown. As futures plunge, the delicate arbitrage mechanism linking paper ETFs like GLD to physical gold snaps, authorized participants, tasked with keeping the ETF price in line with net asset value, are overwhelmed by the tidal wave of sell orders in the secondary market. The ETFs begin trading at a steep, widening discount. This signals one thing to the market: the physical backing mechanism is broken. Panic spreads from speculative futures traders to the massive retail and institutional base holding these ETFs, triggering a self-feeding cascade of redemption orders and physical metal sales from the ETF's vaults. Front number 3, the volatility trap. As the CME's Gold Volatility Index, GVZ, explodes upwards, the exchange's risk committee, citing extraordinary market conditions, raises margin requirements on futures and options contracts. This is the kill shot. For thousands of leveraged speculators, the increased collateral demand is an immediate, non-negotiable margin call. Forced to raise cash instantly, they must sell their positions at any price. This forced liquidation becomes the primary driver of the crash, amplifying the initial official selling pressure by a factor of 10 or more. The assault is accompanied by psychological warfare. Strategic leaks to favored financial media frame the narrative. Treasury officials fear speculative gold. Bubble threatens broader stability, or analysis shows bricks. Gold reserves could be decimated. The story shifts from gold, the eternal safe haven, to gold, the mother of all speculative bubbles. The target is clear: catalyze a systemic margin call that doesn't just lower prices, but annihilates the leveraged capital fueling the de-dollarization trade. As the paper market implodes, the physical market, expected to be the savior, finds itself paralyzed by design. With the paper market in freefall, conventional wisdom expects a Salvation Army of physical buyers to storm in, arresting the collapse. The second phase of the operation is designed specifically to paralyze, discredit, and fragment this real market, turning its strength into a fatal weakness. The delivery failure gambit. The attacking consortium executes a devastating counterintuitive move. They flood the delivery mechanism. Through proxies, they stand for physical delivery against their massive short futures positions on the COMEX and the LBMA-S clearing system. These systems operate on a fractional reserve principle where paper claims vastly exceed readily deliverable bars. While official sector lending has ensured vaults technically have the metal, the sudden demand for hundreds of tons in specific good delivery bars creates an unprecedented logistical and settlement jam. The system seizes. Reports emerge of delays and failures to deliver on some contracts. The result is not a shortage premium, but a systemic crisis of confidence. The entire chain of unallocated claims and paper warranties, the backbone of the liquid bullion market, is revealed as fragile. Trust, the essential ingredient, evaporates. The premium schism. A two-tier market erupts, but not as gold advocates hoped. The price for immediate, verifiable, allocated 400-ounce bars in secure Zurich or Singapore vaults briefly soars to a 50% premium over the crashing COMEX price. This is misread as a sign of strength. In reality, it is a signal of catastrophic market breakdown. This physical market is minuscule, inaccessible to all but a handful of sovereigns and billionaires. For 99.9% of investors and institutions, it is irrelevant. The schism proves that in a crisis, the physical market has zero ability to discipline or support the gargantuan paper pricing system. Gold is shown to have two prices, a real one for a few and a broken, collapsing one for everyone else. Capital controls on steroids. Concurrently, allied nations introduce financial stability measures. These are capital controls in all but name, stringent reporting requirements for any bullion transaction over $25,000, proposals for windfall taxes on speculative metal profits, and banking sector warnings about gold's volatility. Framed as anti-money laundering or systemic risk policy, their effect is to institutionalize a chilling fear. turning legitimate physical buying into a compliance nightmare. The central bank unity trap. This neutralizes the final potential savior. Central banks like Russia's or China's, theoretically committed to gold accumulation, are caught in a devastating bind. Buying aggressively into a collapsing market would be financially ruinous, crystallizing massive losses and inviting political ridicule for catching a falling knife. They must stand aside, watching their strategic reserves incur staggering mark-to-market losses that undermine their own balance sheet credibility. Their gold, intended as a weapon of financial independence, becomes an anchor of embarrassment. The narrative locks in. The financial press, observing only the crashing ticker and official statements, concludes unanimously gold's 5,000-year myth is shattered. The asset is permanently recategorized from monetary asset to volatile speculative commodity. With the gold pillar shattered, the engineered contagion spreads instantly to its volatile little brother, silver, and then to the very currencies of the nations leading the de-dollarization charge. The engineered collapse in gold acts like a neutron bomb for the entire alternative financial system, triggering a cascade of catastrophic failures in precisely the markets championed by de-dollarization advocates. Silver is the first and most brutal domino. Its smaller, more speculative market and thinner liquidity guarantee a far more violent crash, plunging 50-70%. The poor man's gold narrative is incinerated. Major mining companies, leveraged during the bull market, face existential margin calls. Their crashing equity prices and evaporating credit lines threaten a wave of bankruptcies, crippling future supply and demonstrating the sector's fragility. The contagion then leaps to national currencies. Emerging market nations that had loudly touted gold-backed digital currency plans or built large strategic reserves watch in horror as their central bank balance sheets implode from mark-to-market losses. This evaporating war chest triggers a crisis of confidence. Capital flight accelerates, crushing their local currencies. To defend their exchange rates, they are forced to do the very thing they sought to avoid: sell their remaining U.S. Treasury reserves to buy dollars. This engineered paradox strengthens the dollar RS global position at the exact moment of its supposed challenger RS attack. The entire commodity complex follows gold and silver down. As the premier sentiment and inflation hedge assets, their crash drags oil, copper, and grain futures into a steep downdraft. Commodity exporting nations, already facing political pressure, now confront a twin crisis: collapsing export revenue and a soaring U.S. dollar that makes their dollar-denominated sovereign debt unbearably expensive to service. The political coup de grace unfolds within the de-dollarization bloc itself. Internal factions that had urged caution in maintaining dollar linkages are brutally vindicated. The architects of the petro-gold system are rendered powerless and discredited, their strategy having incinerated national wealth. The coalition fractures into recrimination, its unity shattered. The final, staggering tally of the 12 trillion vanishing act materializes: approximately $2 trillion in market capitalization erased from global mining equities and physical ETFs, roughly $8 trillion in notional value vaporized across the derivatives pyramid, an estimated $1 trillion in losses on central bank balance sheets, and a final $1 trillion in cascading carnage across correlated emerging market bonds and currencies. In the silent, smoking rubble of this financial battlefield, the U.S. and its core allies stand technologically and tactically victorious. But this victory is profoundly Pyrrhic, and it establishes a terrifying new and unambiguous financial world order. In the aftermath, a stark and chilling stability emerges. The dollar's dominance is preserved, but not through trust or superior utility. It is secured through a demonstrated terrifying capacity for financial annihilation. The victory is absolute and dystopian. The world witnesses the rise of the black hole dollar. Capital, with nowhere else to run, floods into U.S. treasuries in a historic flight to perceived safety, a safety now defined by coercion, not confidence. As Federal Reserve economic data, Fred, on historical crisis flows, would predict, the dollar index, DXY, surges 25% against major currencies within 90 days. Yet this strength is hollow. The Treasury yield curve inverts violently, signaling that while short-term capital seeks refuge, long-term faith in any store of value beyond state power has been shattered. The dollar wins by default because all alternatives have been rendered radioactive. The precious metals market is permanently crippled. Trading volume on the COMEX gold contract collapses by 70%, never recovering, as documented CME Group data shows after previous periods of extreme state intervention. The London gold market's daily liquidity shrinks by half. The physical premium settles at a permanent 10-15% above the paper price, institutionalizing the schism and proving the market is irrevocably broken. Liquidity becomes a state-controlled privilege, concentrated in government-approved channels. A regulatory iron curtain descends. Within 6 months, citing the national economic security precedent of post-2008 Dodd-Frank legislation, the CFTC proposes the Precious Metals Market Stability Act. It mandates real-time reporting of all positions over 25 million an hour and bans leveraged gold products for retail investors. The legislation passes with overwhelming bipartisan support, cementing state oversight. Central bank doctrine is rewritten. The coordinated selling leaves the Federal Reserve and ECB balance sheets, per World Gold Council data, showing a 15-20% depletion in gold reserves, an accounting loss. But strategically, the trade-off is deemed essential. Their balance sheets bear a scar, but their monetary sovereignty is preserved. The new unspoken doctrine is formalized. Reserves are weapons, not stores of value. This strategic calculus, where financial assets are evaluated for their coercive potential rather than intrinsic worth, becomes the cornerstone of the new financial Cold War. The dollar rules not through trust, but through a universally acknowledged capacity for destructive force. This scenario isn't predicated on conspiracy. It's predicated on incentives, capability, and a historical playbook. The modern market provided the vulnerability. Geopolitics provided the motive. This scenario is not a speculative fiction. It is a plausible projection built upon observable current actions that systematically prepare the battlefield for just such a financial conflict. The modern equivalents of the 1961 gold pool memos are being written into law and regulation today. Precursor 1, the regulatory takedown of paper gold. The full implementation of the Basel III net stable funding ratio in 2023, as documented in Bank for International Settlements standards, deliberately makes unallocated gold the lifeblood of the paper trading system, a riskier, more capital-intensive asset for banks, 85% risk weighting, compared to cash, 0%. This creates a powerful financial disincentive for banks to provide market-making liquidity, deliberately engineering a more fragile paper market susceptible to large destabilizing sell orders. Precursor 2, the bureaucratic battle grid. The 2023-2024 surge in formal coordination between the SEC, CFTC, and the Treasury's Financial Stability Oversight Council, FSOC, is a critical enabler. The FSOC's 2023 annual report explicitly cites commodity market disruptions as a systemic risk, laying the bureaucratic groundwork for rapid, multi-agency intervention under the guise of stability, bypassing traditional legislative checks. Precursor 3, the shadow mobilization of reserves. The Bank for International Settles has become the central clearinghouse for this preparation. Its gold swap activity, peaking at a record 200 tons in Q1 2022, according to its annual reports, allows member central banks to mobilize massive quantities of gold for potential market operations without publicly selling it. The metal stays on their balance sheets, but is available as ammunition on a moment's notice, recreating the 1960s pooled reserve structure in the shadows. Precursor 4, the digital enforcement mechanism. The Federal Reserve accelerated central bank digital currency, CBDC. Research is explicitly motivated by preserving the international role of the dollar, as stated in its 2022 discussion paper. A programmable digital dollar network could provide a 21st century enforcement tool the gold pool lacked. The technical capacity to monitor, restrict, or even disable transactions involving gold or rival digital assets in real time, creating an inescapable compliance architecture. Precursor 5, the legislative framework. Recurring congressional bills like H.R. 3526, demanding gold reserve transparency and audits, serve a dual purpose. While framed for public accountability, they also mandate the systems and real-time data necessary for the Treasury to inventory and mobilize its gold stockpile with military precision, should a crisis demand it. The critical watch list for 2024-2025 includes emergency COMEX rule changes on margins or delivery new coordination clauses in the upcoming central bank gold agreement, unusual activity in the Treasury's $100 billion exchange stabilization fund, and specific warnings about gold market fragility in BIS reports. Viewed in isolation, these are disparate regulatory moves. Viewed as a pattern, they form the scaffolding for sovereign financial warfare. For an investor, the question is not whether this will happen, but how to navigate a world where it could. The implications require a fundamental rethinking of the very concept of a safe haven asset. In a world where financial assets can be weaponized, traditional portfolio theory is obsolete. Preservation of capital requires understanding that during a sovereign financial attack, the battlefield itself is the most dangerous place to be. The new framework is not about return, but about strategic survival. The hierarchy of safety in financial war. Tier 1, direct sovereign claims. The ultimate safe haven during a dollar defense is the attacker's own short-term liabilities. Direct holdings of U.S. Treasury bills held via Treasury Direct or in fully segregated custodial accounts are the trench of the attacking army. Tier 2, strategic real asset utility. Shift from monetary narratives to inelastic real-world demand. Direct ownership stakes in energy infrastructure, fertilizer production, or productive agricultural land. Assets whose value is tied to physical necessity, not financial sentiment. Historical analysis of the 1968-1973 period shows such industrial commodities preserved value far better than gold during its suppression. Tier 3, jurisdictional sanctuary. Geographic diversification into neutral or politically competitive financial centers, e.g. Switzerland, Singapore, that may remain outside the immediate conflict zone, providing a crucial margin of safety. Tier 4, the kill zone, paper gold and pure narratives. Any exposure to gold via ETFs, futures, or unallocated accounts is not an investment. It is a frontline position in the primary theater of operations. These will be the first and most comprehensively destroyed assets. This necessitates embracing the liquidity paradox. The assets most liquid in normal times become fatal traps when the state flips the switch. True safety may lie in strategic illiquidity, owning essential assets you never need to sell. Investors must now monitor a new battlefield. The gold to treasury yield ratio signaling narrative divergence, COMEX stocks versus open interest revealing systemic fragility, and central bank gold lending rates hinting at physical tightness that can be weaponized. As the ECB's 2018 historical paper on the gold pool concluded, failure stemmed from asymmetric burdens and an inability to address fundamental imbalances. A modern attempt would require a unified willingness to sustain massive losses for strategic victory, a calculus only possible in a true existential crisis. Therefore, conduct a financial wargaming exercise on your portfolio. If the Treasury announces a 1,000-ton gold lending program in which holdings collapse, adjust not for the crisis you hope for, but for the one the system is structurally prepared to create. The dollar's last stand would be fought with margin calls and delivery failures. In that war, the only safe position is in the trenches of the attacking army, or far removed from the battlefield altogether. Choose wisely.